Joining us now, Robert Kaplan. He's Goldman Sachs Vice Chairman and, of course, the former Dallas Fed President. Mr. Kaplan, welcome back. It's nice to see you again.
Good to see you, Scott.
Our prior guests during our market conversation a few moments ago have doubts that Mr. Powell can pull this off. You share those doubts?
No, I think they have a reasonably good chance to pull this off, meaning a soft landing. First of all, we're running 7% of GDP deficits fiscally. In other words, a historically high deficit at a time of full employment. Some of that's higher interest, but some of it's higher spending. And I think that's giving some resiliency to the economy. So I think in Jay Powell's speech, he made clear they're going to move in September. He left his options open as to how much. He made clear that they're going to balance employment and inflation, and they don't want to let the job market get any worse. And I do think we're going to find out from the August jobs report there's a reasonable chance that that may actually be better than people think. So I think we've got a reasonable chance to navigate this. And if the economy turns out to be weaker than I just said, then the Fed can do more.
You think they should go 50 just to be safe?
I think a lot of it's going to depend on the August jobs report. And so I would withhold judgment on that if I were in my seat until we get to the first week of September. And again, if that job report is weak, they'll go 50. If it's stronger than people are expecting, which is a possibility, then I think they'll go 25. And they'll do that in order to move more deliberately and be able to control the pace.
But see, that speaks to one of the criticisms now, doesn't it? That they're too data dependent at this point, that they're already way too restrictive. So why not act faster to bring the rate back down?
The fact of the matter is, if they're late, in my opinion, they're late by a meeting or two, but that's not even clear. And this is actually, there are times where the structural drivers, I think, ought to take more precedence. The amount of fiscal spending is one of those structural drivers. I think when you're tweaking, whether it's 25 or 50, and how fast you want to get the next 75 basis points or 100 basis points of cuts, I think actually looking at data and how it evolves is actually not inappropriate. So I think they've got the balance about right, actually.
But you still sound like your principal concern in all of this is the still rising deficit and the cost of funding it and the impact that that's going to have on interest rates in the future.
Yeah, I think I have a couple of concerns. One, in the near term, I think the economy is weakening. Anything interest rate sensitive is weaker. The jobs market is weakening. We needed that weakening to offset some of this fiscal spending. And so I think we've made enough improvement that we can start cutting rates. But yes, secondly, I think the big issue over the horizon, the debates won't be about monetary policy over the next year or two. I think they're more likely to be, how do we deal with debt to GDP that's over 100% in an aging economy? How do we get higher growth? How do we get more productivity? How do we deleverage? And I think that's more about fiscal policy. I think the Fed's got a runway, in my opinion, to get a couple hundred basis points of cuts over the next year and a half, 2 years. I mean, the pace we'll figure out, but they'll do their jobs. I think the bigger issue, we've actually got a glaring issue on fiscal, and I don't think it's being focused on right now.